Welcome to SmithWeekly Discussions, an occasional program for our readers and listeners of SmithWeekly Research. Please note this program is a private discussion and everything contained herein is for entertainment and educational purposes only. With that, we hope you're in a comfortable position, along with your favorite beverage, to enjoy the discussion. We remind our audience to examine the show notes attached to each of our shows to better understand how our program functions. Before we get into our discussion, we want to say thanks for questions coming from our audience at SmithWeekly, including Paul M., Cyril O., and Brent S. Returning to the show is Brian Lax, Portfolio Manager and Partner at Old West Investment Management. Old West is a value-focused, long-short, and special situations capital group based in Los Angeles, California. You can learn more at their website, oldwestim.com. Brian, welcome back to the show.
Hey, Andrew. How you doing?
Good. How's things in the People's Republic of California these days?
It's same as it ever was. We're trying to get along.
It's still the People's Republic, right?
Well, I don't think that won't change for a while.
Well, what's been happening at Old West during 2019, and how is performance coming in so far?
We're doing pretty well. It's been a good year. It's tough to compete with a market that just keeps rocketing up and up and up every day. But we're doing all right. Some of the things that we've been holding on for a while finally starting to do well. We have a pretty big position in gold that's had a nice move this year. We've had a couple of names that have really started to do well that we were had held on for a while. I think actually one of the names we talked about I think it was about a year ago I was on your show was Enphase. And it had gone from 1 to 4, and we were talking to him, and it was a huge run. And this year it went from 4 to 30. So it's been a pretty wild ride for some of these things. And I remember last year when we talked about it, we were talking about some of the timing, and how when we got in, I think it was, I don't know, maybe $1.50 or so, and it had gone down over the next few months all the way below $1. And it's tough when you're looking at a name like that and you see you're down kind of 30% plus and, starting to question your thesis and wondering, should we get out of this thing? Are we doing the right move? And then, you fast forward a couple of years and you're up, 30 times. So I think maybe let that be a lesson that, early is not always wrong. I mean, sometimes it is, but, as long as you have conviction in the thesis, these things play out. And, I guess the biggest criticism that I get from my team is, why were we trimming it on the way up? We should have held this thing. It would have been a monster. But so we're having good years with stuff like that, and there's still parts of the portfolio we're waiting to perform, and we still have conviction in the thesis. It's just some of these things take a while, but I think for our investors, they believe in the process, they believe in what we're doing, and so they're willing to let these things play out.
Oh, very well, and good for you on gold. I think that's fantastic, and some good performance there. What has been lagging besides the obvious? What has been lagging over there, or maybe stuff that hasn't worked out?
Well, I think value stocks in general have struggled. It seems this market is heavily momentum driven. It's driven by a handful of names. And people just don't really care about the stuff that hasn't been working, even if it looks attractive on a fundamental level. And so, we own, obviously some commodity stuff that we'll probably talk about later in the program. We own some media names that haven't done too well. We had some energy. We've been scaling out of it. I was pretty concerned about it going back a year ago or so. And so it's tough because these things seem cheap. They're so beaten up, and yet, for a lot of these areas that are beaten down, you really need to see a way out of them. And so we've had some pretty active discussions about our energy exposure. Look, obviously that's done terribly right now. We have almost no energy exposure, and it's one of those things where should we have some because it's contrarian, or is it fine that we're so low, comparatively compared to what we had in the past? So. Look, there's parts of the market that haven't participated in this rally. They're few and far between. It seems like you throw a dart anywhere, the market's up 25% this year, you're gonna do pretty well. And so we've had a good year, but you need to own some of these really high flying momentum stocks to keep in line with that. And so, look, we're comfortable doing well, even if it's relative underperformance, because we think that the areas that we're in that haven't performed yet are, it's just that yet. I mean, we still believe strongly in the thesis. We think they're going to do just well. And, like the example I just mentioned, I mean, we've had some of these stocks where, you're down 30% before you're up huge. So I think, for us, we don't really get too beaten up about stocks that if we don't catch the ultimate bottom, because a lot of these areas we're looking at are ones that have been beaten up or down or for various reasons, because we think that's where you find a lot of these big asymmetric returns. And yet it's very difficult to time, hey, I'm going to catch the exact bottom or I'm going to catch it on the upswing. So sometimes you're a quarter or two early and you got to take a little bit of pain, but that's fine. I mean, for us, we're happy to do it. As long as you are, right at the end. I mean, it's fine to have that, short-term pain for the long-term gain.
Right. Absolutely. No, I can think of many, many names where it started out bad and declined significantly before things returned and got much better. And it was the right move. Tell me a little bit, what's your guys' thoughts over at Old West? How is the broad market holding up? And how long do you see that this party can keep going?
Well, personally, I probably thought it should have turned in 2011, so I'm probably 8 years behind on that. But I don't know. It seems like it can keep going for a long time. I mean, it's not really the things that are driving it. I mean, it's really don't fight the Fed. Look what they've done in the last 2 months. I mean, they threw $300 billion into this thing. It's up, I don't know, 8% in 7 or 8 weeks. It's amazing that the U-turn they've had. They want this thing to go higher, and it seems like they have bullets in the gun to do that. There was a lot of discussion maybe a year or two ago that they were running out of things to do. Interest rates were at rock bottom levels, and then they said, okay, maybe we'll start raising them. But it's been amazing how when there's just the slightest hint of trouble, these things they all start running and saying, how do we save this thing? So in that respect, it's difficult to fade this. I mean, our short book is probably as small as it's ever been, which maybe is a bad sign. We always talk about this in our investment meetings. Is man, of course it's like a contrarian sign. Like right when our shorts get as small as possible is when the thing will break. But my thought has been it's very difficult to short in this market because there's so much pressure squeezing this thing to the upside. And so, you might be right eventually that, hey, this market deserves to, let some air out, but how much pain do you want to take riding that up? And so, we've shifted a little bit towards, more kind of long-term put, option exposure where you can have, less capital at risk and, it's pretty fixed versus what you can make in terms of the downside. But it's really tough because a lot of these, unless there's something really broken with the company, it seems like shorting something based on valuation in a market like this is more of a market call than a company call. And so, do we really want to short this thing because it's 30 or 40 times earnings and we think it should come down? Well, if that's what the market wants to pay, I mean, that's what they're going to pay. And who says they don't pay more? We see a lot of arguments out there for why the market should go much higher, right? I mean, if you compare it to interest rates, I mean, what's the 10-year, 180 or something. Well, if you flip that, that's like a 55%, yield or earnings yield, right? So it's 55% PE ratio. Hell, the S&P's got a long way to go, right? So, it's difficult to make just kind of valuation calls on this thing because you're really kind of planting the flag in the sand and saying, hey, the whole market's going to turn and just in general, investors are going to want to pay less for these stocks. And it seems like that's not the case. I mean, they're willing to just continue to mark up these names, especially, I mean, even given that, the fundamentals haven't really improved. I mean, maybe on a per share basis, you're seeing, earnings per share growth, but a lot of it is just driven by buybacks or by, especially companies taking advantage of low interest rates. And it's almost like capital structure changes that are really driving this. So, on the short side, it's tough. We're still extremely cautious. I mean, it's watching it kind of with this detached amusement, like, oh my God, how high can this thing go? Especially with so much kind of underlying that doesn't seem to be going very well. And yet it just, we our view is, why don't we just wait until this thing, markedly turns? There's no reason to call the top. I mean, I think unless there's like a 1929 type crash where it all unwinds in a single day or over a period of a couple of days. Well, most of these bear markets that come over time are multi-month, multi-quarter periods. So there's no reason that you need to, be at the top. You can wait till it starts and then start to get short. But for now, I mean, it just seems like it's up and away.
Right. It's difficult to short, even if it's a fraud or if it's a bankruptcy scenario. I mean, it's very difficult. Evaluation, yeah, you're just wasting your time there. So
Yeah, well, and
even when
look,
you add all, yeah.
even the frauds. I mean, even the frauds are tough to short. Well,
Oh yeah.
the supposed frauds. I'm sure you have a few in mind, but it's amazing the strength that you see there. I think people, it's just a suspension of disbelief, and while the parties are going, you got to dance, and I think that's what a lot of investors are doing.
Right. And one of the interesting things about the long-term put options is, yes, they are a wasting product, but you can be wrong for a couple cycles in those put options, and then of course they will pay off substantially, even if you've been wrong for a number of years.
Yeah, and
That's
I mean, and so you don't really need a lot. I mean, maybe a couple percent a year is insurance.
right.
People buy insurance in a lot of other aspects of their life. I think it's similar to do it here. It seems to be in a market environment like this preferable to just, taking shorts that seem to go up into defying all the odds. So, that's why I say our short book is pretty small at the moment. And then we have some of our longs have a sort of pseudo short characteristic. I mean, it's where they will do well in a more volatile market environment. I mean, you mentioned the gold, and that's a perfect example where it seems to be anytime the market gets spooked, there's this flight to gold, and so it's gone up a couple $100 this year, which is pretty amazing given that it's also gone up with a strong market and a strong dollar. I think that shows the underlying uncertainty that's out there, and that people do have some need for protection, whatever way that may materialize, and or maybe it's just a commentary on the fact that a lot of this has to do with central bank intervention, and the fact that if they keep throwing money at this problem, eventually that money becomes worth a little bit less, and something like gold should do well.
Right. No, I say it seems that it's only a matter of time before the Treasury puts printing presses in every household.
Maybe so. Depending, well, there's an election coming up. These guys are fighting over each other to see who can give away the most money. So maybe that's coming.
It truly is a clown show. There's no doubt about it. Well, how about I was speaking on other items. Certainly back to the put options. We know we're probably in round two of long-term put options, so we've had to experience some pain. But again, it's fairly insignificant for some insurance to the portfolio. So I think that makes a lot of sense. And before I talk, I want to ask you a bit about gold and how you guys have succeeded there. But can you speak to maybe another sector? I understand you guys probably have some interest in biotech, and have you been looking at the shipping, offshore oil services industries?
We have. Yeah, we've actually looked at both. I'll start with the biotech. Yeah, actually, our largest position is a biotech stock. It's a company called Raphael, and we're not really biotech investors. I think it takes a lot of specialized knowledge to really do well there. But this one came about more just following our process of following people that have interesting track records. And so it actually came about because of our investments in media. So we have a number of media investments. Kind of the thought is, all these big companies are throwing tons of money at content, and where are they going to get that content from? Their budgets are through the roof. They don't care if they make money. The Netflix, Amazon, Facebook are all throwing money at content. So we've had some, we've been looking at media for a while, and who has the content to do that. And so one of the companies that we owned was owned, the major shareholder was a guy out of New York who we've followed, has a really good track record. And my partners were in New York, had a dinner with him, trying to ask him about this media company, and all he could talk about was a biotech that he owned. And so it's a company called Raphael. They have a pancreatic cancer drug, and pancreatic cancer is just the survival rate there is abysmal. It's one of the worst ones. And so this was an interesting thing because the guy, he's a billionaire. He got involved with it a few years ago, put some money in. He's the largest shareholder now, And it originally was part of he has this telecom company that he kind of uses as an incubator. And so, he mentioned it when we were trying to ask him about his media companies that had been spun off, and he was so excited about it. It's all he could talk about. And so we started doing work, and I mean, it was pretty fascinating, the results that they've had in pancreatic cancer. I think in their phase 1 trials, I mean, they were small trials, but they had several complete remissions. I mean, it was kind of unheard of. So, we did a little bit more work on it, and we said, hey, this is kind of an interesting one. And really, it goes back to our process, which is the focus on people. And this guy, and my partner covers most of these names, so he knows all the details. But this guy, I mean, he started out as a hot dog vendor and essentially, made his way. And now he's a multi-billionaire. Probably his big claim to fame was he bought some spectrum assets out of the wreck of the tech bubble back in 2000, 2001. He paid $50 million, and 15 years later, 18 years later, that's what was Straight Path, which was sold for $3 billion. So he did pretty well there. And his business, this telecom holding company, it's kind of it's very, there's a focus on capital allocation. So his original business was international calling cards. I don't know if you remember those things, but people used to get these cards and they dial the number on them, and it was a callback service. And so, that wasn't very long for the world, but he took the cash that he harvested from that business and he would allocate it to these other growth initiatives. And so since then, I mean, he's had a great track record with performance. He's spun off a number of these things. And so that's how we got involved in one of these media companies. But so, when he was telling us about this cancer drug, we ended up actually buying the telecom to get the spin out, because of the results that they had. And the way they structured it was where they put a bunch of cash on the books. They gave it a building, which was their headquarters building. So they had some, rental income coming in. But so when this thing was spun off a few years ago, I think it was spun off at like $6 or something and dropped down to 4. Cause this is one of these areas that a lot of value special situation investors look at are these spinoffs, because a lot of times, it was spun out of a telecom company. So the guys that own telecom and they get it in their book, they're like, I don't want this thing. What's this biotech, right? And at the same time, because they didn't have their, the drug is still kind of in trials, their only real revenue was coming from the rental income from the headquarters. And so actually Bloomberg still lists it as a real estate company. And so you have this kind of orphan company where no one's really paying attention to it. So it dropped all the way down to $4, which was, I think, a $70 million market cap. And it had 40 million in cash, and it had, this huge headquarter building that was probably valued at 50 or 100 million. So we thought it was a slam dunk just based on that. That was $4. The stock's at 20 today. But really, I think the interesting thing there is, they have this drug that, the results were so good in phase 1, the FDA essentially let them skip phase 2. So they're in phase 3 right now. We're watching it, and really the interesting thing is, and like I said, we're not doctors over here, but we're just kind of following the smart people. Is the approach they have is pretty novel. It's there's chemotherapy there, which is they just blast everything with the drugs. There's immunotherapy where they try to get your immune system to attack it, to attack the cancer. These guys, it's called altered metabolism, which is they essentially notice that the cancer cells and regular cells have a different way of fueling themselves, of metabolizing energy. And so their drug targets just the cancer cell metabolism, I think, in the mitochondria. And so, I mean, the results have been pretty impressive. And so, it's something like that where, look, I mean, we don't own a lot of biotech, but it's something like this where we've, kind of aligned ourselves with a guy with a great track record who he still owns, I think, half the company. And we're very excited about it. I mean, they've already been doing out licensing agreements, and it sounds like this altered metabolism platform they have will be the future of the company. It seems like they're kind of positioning themselves, if they have continued success in the phase 3, to essentially take this individual compound, hive that off, and then the remainder will be more of a platform type company where they continue to develop drugs with this methodology. So, like I said, it's different, it's unique. But we find these areas that are kind of overlooked, and like I said, I mean, it was spun out of a telecom company. So who's looking at that type of stuff? For us, right. That's very intriguing, right? So, there are things like that.
So where did that come from as far as when did you guys come across that, and where is the stock today?
So we bought into the parent pre-spin out. So we've owned this company. So like I said, we were in media, looking at the content one. So the company we own is called IDW, and they were, one of the largest producers of comic books. So you talk about some of these strange areas that we look at. But so this was a huge comic book company, and they were essentially taking they had a big library of IP that they were turning into TV shows and movies. They were kind of doing this transition to become more entertainment focused. And so that was a few years ago. We've been watching this for several years. That's how we came upon this guy, this investor who was instrumental in all of these things. So let's see. So Raphael came public. It was spun out, I think, in early 2018. So we were probably talking about it in late 17 when they said, "Hey, this is the most promising thing we have." The company's called IDT. It's the shell company, the telecom that spun all these things out. So we actually were like, okay, this is an interesting one. We own a number of the spin outs of that company, and so we said, okay, let's take a look at this. And I think we bought probably IDT maybe a few months prior, just so that we would have access to the spin. And then when it came out, it was a incredibly cheap valuation given the cash that they had on the books and the building. So that was, I think, $6. It went down to $4. We were buying more. And it's kind of, it's $19 today. It's it was as high as almost 30 earlier this year. It's kind of moved in fits and starts. It has these runs and it pulls back. Usually they coincide with conferences. There was a conference earlier this year. I forget which one it was, but they went from, that was one of a big run they had from kind of 8 to 18, and then they pulled back, and then they did another one where they ran to 30, this summer. So, it's interesting because in our view, one, the results have been staggering for the success of this drug, especially in a disease that, it's a death sentence. The survival rates are terrible because a lot of people don't notice it until it's too late. And so the fact that they've had complete remissions, it was a small sample size, so we're waiting to see how they do, in a larger population. But I think really the thing that has, it's only a $300 million company. I think the thing that has really, kind of held it back is that just the lack of awareness, right? It was spun out of a telecom. It's listed as a real estate. No one really talks about it. But then every time they go to a conference, people are like, oh, where'd these guys come from? And the stock has these huge runs. And so, I think that's attractive to us. We're very close to the investor, the largest investor. My partner probably spends a couple times a year with him. He's very, very, very smart guy, and thinks this is it. So we're as much as we understand the space, I think it's exciting to have all of these things aligned. You don't necessarily have to be a specialist in everything, but it's important to know who the smart people are so that you can follow them. And I think if you look at who's involved with this company, it's a number of Nobel Prize winners. It's pretty impressive for a company of this size and this results. And I think it's only a matter of time before that awareness gets out to a wider audience.
Well, I'd recommend the audience do some digging around and find out more about the company, look them up and find out the backers and the people involved. I think it's pretty interesting, some of the stuff you mentioned there.
And shipping. Well, so look, we've owned a shipping company for a while. And this was one of the ones, when we launched this new fund, the idea was not necessarily a uranium fund per se. It was more of a thematic special situation opportunity type fund. Shipping was one of the areas that we looked at, along with, natural gas. Some of these things that are really beaten down, fertilizer, agriculture. We looked at all these things. And the question is, okay, all these are beaten up, how low can they go? How low should they go? Should they be? Is there a reason they're down here? Is there any reason to believe that they turn around? What is the catalyst? What is the timing? What is the upside? And so we kind of went through this matrix for all of these areas, and shipping was a big one. And I had a whole sheet of all the shippers, and we did all this work on it. And it seemed like, okay, it's probably going to be a few years for a turnaround. Looking at scrap rates and the order book and all that stuff. I think really what happened with the sanctions on Costco was a really big catalyst. You look at what happened to rates. They skyrocketed. I think they went up, 10x in a month or two. So, we still own the shipping one we've owned for a long time. We haven't gotten the same sort of leverage to the improving rates because we own this one for the downturn. I mean, it was essentially they were very conservatively managed, where they had 75% of their fleet was on long-term contracts, and so they didn't have as much spot exposure. But as their contracts roll, they'll be able to re-sign at higher prices. So we still own that. But the other one we're really looking at is that Scorpio, which I'm sure a number of your listeners have probably taken a look at. A number of value funds have been kind of active talking about it. This one, going back to our process of looking at insiders, looking at how much do they own, looking at insider transactions. This one, I mean, just jumped off the page because the CEO a couple of months ago, a lot of times we'll look at, are they buying stock? Is it a big purchase? Is it a big sell? And then that's a starting point for us to look at these companies. But this guy, I mean, he was buying millions of dollars of call options, and short-term call options, with only a couple of months of expiration. And so we're like, this is, I've never seen anything like this. I mean, some of our best ideas have been stocks where the stock's down for some reason, and you'll see the CEO come and he'll buy 30 million or 50 million worth of stock. I mean, we've had really good positions. I mean, in fact, the Enphase one was one where we saw a really big insider transaction. That's what kind of got us interested. But so we looked at the Scorpio and we said, man, I mean, this guy's come in. I've never seen a CEO load up on short-term calls. I mean, maybe you have. I don't know. That's something strange in my opinion. So I think for us, when we reverse engineer something like that, you see the big move in the spot rates. And I think the stock did move. I think it ran from 17 or something up to 30, so it almost doubled. But I think given the move in rates, I mean, even if they pull back, and actually one of the value managers that we follow did a pretty good write up on it a few months ago, just looking at what this company can earn, even given a conservative assumption in rates, and they're essentially earning a big chunk of their market cap every few months. I think it was very staggering to see, and so no surprise that you have the CEO who's out there saying, hey, yeah, our stock has doubled, but you know what? With rates here, it should go a lot higher. And not only am I going to buy stock, I am going to load up on, short-term calls. And so, we own a little bit of this one, which we've been watching it for a while, and that kind of goes to how we do some of these things. Is we'll have these names that are on our radar for a while. We'll do some preliminary work, and then we'll kind of put them away. And then every so often we'll come back to them when something comes out in the news. And that was the case on this one, which is it was on our list of the shipping companies that we looked at. And then we see, when you see a CEO come in and do something like that. And I think the stock was around maybe 28 at the time. And I'd have to look today where it's at. It's probably, he looks like he's done quite well. It's at 36. So, whatever that is, he's done, he's done pretty good, up 30%. I'm sure his calls are up, multiple of that. I'd have to pull up the sheet to see how well he's done. But, I think there's things like that where, you've been looking at this name and you have it kind of stewing in the back of your mind, and then you see something like that where you're like, okay, something else is going on here, and it causes you to really kind of either, dig in a little more or actually take the plunge.
Anything in that sector, whether it's the tankers, the bulk shippers, or offshore oil services, any of those that haven't really performed yet that you guys are involved with that you like?
Well, I think, like I said, I think when you have a move like that in the rates, it's the conservative guys that do the work. So we've owned this company, Sakos, which is they're in the oil tankers. They're making a push into LNG. It hasn't really done much. It's been kind of flatlined for 2 or 3 years. It started to move off the bottom with the rates, but people looked at it. It hasn't had the same leverage as some of these guys that are more spot exposed. But I think there's still a good argument to be made for it because, even though they are, they had their long-term contracts that got them through this downturn, those will eventually roll off, and they'll be able to re-sign at higher rates. And I think so, even though they haven't had the same leverage, they're still perking up a bit. Obviously not as much as some of the other ones. So, we watched that. We watched the offshore oil. Just oil and gas in general. Energy has been so beaten up. It's very difficult to find the light at the end of the tunnel. It's funny we say this on the day that Aramco lists, and of course is trading a limit up, but maybe that has more to do with the fact that its float is less than 2% of of the outstanding. But I think there's a lot of these areas where and you start to see the private equity guys moving. I think natural gas is a perfect example. I mean, it's just been beaten to death. It's just down so much, continues to go down. Everyone tries to call a bottom. It continues to go down. It's hard to say. I mean, we need natural gas. It powers a lot of our electricity. It warms our houses. But there's just so much of it. I mean, they're a victim of their own success. These monster wells that they're drilling up in Appalachia. So I don't know. Are the companies worth more than the debt? I mean, that's really the question there, because it's possible that that they will be around, but maybe not as public entities, and maybe the private equity guys that are kicking around there now are just going to be picking up these things, and they have the ability to sit on them for a few years until demand goes up or whatever it takes. But it's tough. I mean, like I said, our energy exposure is about as low as it's been. We have some long-term calls on some of the offshore guys, thinking eventually utilization is going to have to pick up. I mean, especially if the shale crashes, if even more than it has crashed. I mean, we hear guys talking about a wave of bankruptcies still to come, because a lot of the shale performance has just been a function of cheap money, right? The decline rates are so steep. You got to keep putting money back into the ground, and it's this treadmill that you're on, and hopefully you can make it out. Your production grows enough that your base decline rate on your whole company gets low enough where eventually you start turning free cash flow. But you're dependent on cheap funding to get to that point. And so, look, we've had it for this long, and these companies have survived. But if they go away, one of the questions we've been trying to ask is who. If you do want oil exposure, if you think, okay, oil's not going away anytime soon, maybe in the future, it goes away, but down the road. But if you do want it, where do you get it? That's not shale. I mean, it seems like a lot of the U.S. operators are almost entirely onshore are shale. So, we've been looking at maybe some of the oil sands up in Canada, or some of the offshore guys, the big diversified companies. It's tough, because who's going to be the last one standing? And what's the catalyst? What's going to cause people to come to natural gas and say, oh yeah, it shouldn't be $2 or $3. It should be $5. I mean, and maybe it's a huge shift in demand if we're all of a sudden starting to ship a bunch of LNG, or maybe, I don't know, exporting it by pipe, north or south. Who knows? But at this point, it's hard to see where that comes. I guess maybe it is more appropriate for someone who's got who can just sit on it in private. They don't have to put out a monthly performance report and say, hey, I don't care. I'll tuck it under the bed for, 5 years and see where it is when it comes out. So, we look at these areas, but we don't always participate, because we think that maybe the time horizon is too long. And maybe there's a chance you can, just as well buy it a year from now in the future at the same price or lower. And so, that's why I said, like, for this fund, the one that I manage, it's not a uranium fund per se, but it just happens to be a lot of that, because that's the area that we think has the best upside, the best timing, the best catalyst, and all of that. But we keep an eye on all these things. I mean, I think just today I saw an article on on rare earths, and we have some rare earth exposure, and some of these names in the U.S. Are getting a pretty big pop, and it's because the government, these are critical minerals, and the government's trying to boost the supply chain. And so, I think we kind of have that nimbleness where we can, go to where we think the best areas are over the next few years. So we're watching everything, but when we do find the place that has the best combination of upside, of catalyst, downside protection, that's where we'll really dig in and do a lot of the work, and that's where you'll see the bulk of our position.
Yeah, interesting comments you have. You would want to think that the offshore space is going to be the best economic situation going forward for oil. That may not be the case, but I want to, in light of the onshore issues and the Canadian issues with the pipelines and transport, and just the fact that most of these projects are just economically upside down or too costly compared to offshore, you would suspect that at some point offshore would really be the place to come back to, because of just the sheer volumes and really the quality that you can get out of really good assets offshore. And I just noticed that Chevron, there was an article that came out, I believe it was today, actually, Chevron.
Yeah, huge write down.
huge write down and expects prepare for long-term low prices. And now
Yep.
that could be self-serving, or it could just be a contrary statement there to where we could probably expect higher natural gas prices.
Oh, well, maybe it's a signal, and I guess I should say, rather than offshore, we were trying to look for conventional, right? It seems like, where they just stick the straw on the ground rather than fracking and doing and going into the shale. I think
True.
it's tough, if you're looking in the U.S., I don't know, find a U.S. guy that's not doing shale. You either have to go to the majors or or you have to go offshore, and so I think that's why the oil sands look interesting. And I actually did a lot of work on the oil sands in my last role. We were when I was just covering energy, and so at that point they were doing all this capex build out, and the point was, years down the road we'll have this wall of free cash flow, and it seems like they're getting to that point, and yet the oil price isn't really cooperating with them, but they're still doing all right. And I think the difference is they don't have that steep decline and that treadmill of reinvestment need where if you get cut off from the capital markets, you're screwed. So, but that said, like you still need to have a view that oil is going to be higher in the future. I think for these things, maybe it is. I don't know. I see arguments on both sides of the table. I think that for me, it's kind of a coin flip. I see good arguments for why it should be higher. I see good arguments for why it should be lower. We don't have to make a bet, right? So I don't have to take that. I'd rather go to an area where I see really compelling upside somewhere, or if I'm for the short, really compelling downside, and do it that way. So we don't. That's why we're concentrated in a number of these areas, because we think that that's where the best opportunities are, and we're fine. Look, if those things actually do, if the roulette wheel does land red and those things do go up, okay, well then we missed it. But I think I'd rather find something where the risk reward is skewed in my favor, so I don't have to worry too much about it.
Right, absolutely, and certainly one of the things you brought it up there is just the price where the oil price is today. For example, offshore projects can be potentially fantastic even at current oil prices, so you may not need those necessarily to rise. So you can look to places that have utilization issues and rig count issues, scrap issues, and so forth, where you have, even in the offshore services sector, you don't necessarily need a higher price for oil, but just because of the washout that's occurred really since BP Macondo, you can start to look that, yeah, maybe this actually is going to work out pretty nicely, even if oil doesn't go anywhere. Let's move on, Brian. Let's talk precious metals, base metals for just a moment. You guys had some involvement with gold earlier this year. What do you see for opportunities there, and how did you play the gold run this year?
Yeah, we still like gold. It's still a big part of our portfolio. We caught a lot of flack the last few years for that. People saying, well, why do you want gold? It's done nothing. It's been flat. Our view has been that this move that we saw this year is just the start of something bigger. It's a shift. It's still widely underowned, I think, in a lot of portfolios. And yet, we think everything points to higher gold prices in the future, just because there is so much uncertainty. No one knows what's going to happen with this era of central bank manipulation, but it seems like they're all tripping over themselves to print as much money as possible. That has to eventually turn out good for gold. And I think that's what we're seeing with the start that we've had so far. We've done similar to the rest of our portfolio. We follow smart people. We follow insiders that have big stakes. We follow big purchases. And so I think one of the ones that's done really well for us was this Kirkland Lake, where we got involved fairly early because we saw that it was a very high insider ownership. I think Eric Sprott had hundreds of millions of dollars invested in this thing. It's probably worth billions now. I think that he was trimming some of it though. But this is one of those things where we're just looking for who's got skin in the game. Who are the guys that are basically putting their money where their mouth is. And this was a huge position for them. So we got in, and it's gone up 3 or 4 times. And so at that point we say, okay, and look, fairly so. I mean, it was extremely high cost, extremely high grade, very low cost ore. They just, every time they put out a news release, it was like they had some other, crazy, high mine grades. And so it was it's easy to justify the run that they've had, but now they're massive. It's like a $5 or $10 billion company. And, the position got so big for us that we said, okay, let's scale back and look at, some other options. And one of the ways we go about it was let's see who was talking about this company back when it was very low, right? I mean, that's one of the ways we kind of identify smart investors is you reverse engineer it. You see something that's done well, who called it, who was there ahead of the move and saying, hey, this is good, this is what's going to happen. I mean, that's why we point to that end phase. We tell people go back and read our 3Q 2017 letter when it was $1.50 and we laid the whole thing out. And after it runs, we say, look, there it is. That's it. And so for gold, it was like, okay, who was writing about this company when it was 3, 4, 5, $6, and now it's, I don't know, 40 or 50. And what else are they talking about? Is that same insight repeatable? And so we found some people that were pretty smart on it, and so we moved some of that into a company called Atlantic Gold, which was up in Canada. And a lot of this kind of goes to just our general thought process for gold, which is it's very important to understand the jurisdiction that your mines are in. I think you can find some really high grade mines at low valuations in other parts of the country, but if you see what happened in, I guess it was Burkina Faso or Mali, I mean, there's a lot of strife in other parts of the world, and you can have a very nice money making machine there, and then it gets upended because of something that happens just on the ground there. So we really preferred these things that were in Canada or Australia, safe jurisdiction. So Kirkland Lake looked good. We did some work on this Atlantic. We thought it looked good. It was these were the positioning that we tried to have was, originally we still own Barrick Gold. We like the big one. We really like Mark Bristow. We think he's a great guy. He's really smart doing what he's doing. But we thought, the sweet spot are these companies that are kind of, the developers, the intermediaries where they do have production. They have a way to increase their cash flow. They're almost gold price agnostic, right? Where a lot of companies, you need the gold price to go up for them to do well. This is one where, if gold price is flat, they're going to do fantastic. And so that was Kirkland with their continued resource expansion, really high grades. That was this Atlantic where they had a path to increase production, even in a flat price environment. Sure enough, I mean, we didn't even own that one for that long, and it got taken out at a nice premium. And then we went from there, and then the next one we got into was this one called West Dome, which is a couple mines up in Canada, and it's the same thing. It's just they have good results. I mean, it's a very I think you're seeing there's fewer and fewer of these stories where the jurisdiction is good, the grade is good, the size is good, and people are marking them up. And this one's already had a nice run. I mean, it's been a huge winner. So we're already starting to think, okay, what's going to be the next one? And so that's actually where we are now, is thinking, okay, our view is this company probably gets bought pretty soon. I mean, there's been a lot of M&A in the space. You've seen, it seems like day after day, there's, another deal is announced. There was a number of gold deals announced a week or two ago. So, for us, it's, how do we replicate the success that we've had in the past? What was the formula that caused us to either identify these companies or, that caused these companies to do well? And do we see anything in other companies that have those same ingredients where, the move hasn't already started yet, right? Because that's really how you find the good companies. And then if we can duplicate what we've done in terms of is there good insider ownership? Is there any insider buying? I mean, those are all the things we kind of add up. And when it ticks enough of the boxes, we say, okay, this might make a good investment.
Yeah, certainly. And Mark Bristow's a solid guy, probably the best big company leader in the space, hands down, very smart guy. And the Crocodile New Market team, which kind of made Kirkland what it is today to some degree, those guys are off doing something else now as well. And yeah, some interesting stuff going on in the space. The M&As, the recent Sentiment Egypt takeover that's trying to commence here as far as a bidding war for that company. There's a lot of interesting stuff that's certainly taken place in the space, and I'm in full alignment with your view that this is just the start for this sector to get going. Is there anything in the gold side that hasn't worked yet, Brian, that you guys are holding on the portfolio? Is there some that haven't taken off?
Oh, I mean, we don't really own that many names. I think we have pretty big positions in the ones that we own, and so no, I think we mentioned all the real ones that we own. So I think we do own some, I guess, smaller positions in some of the big undeveloped deposits. Like we have some Nova Gold, we have some Tower Hill. those are probably longer term plays. They take a lot of capex. They're big deposits, and I think their time will eventually come. And they're really those have the most leverage to a rising gold price. And so where we think the sweet spot, or either in something like a Barrick where it's big, Bristow's making a lot of moves, doing M&A and divesting stuff, and then we have these sort of more operational oriented plays. We do have some exposure to some of the big deposits that are maybe capex heavy, or they're going to need some work to be done. But at the same time, there's not a lot of big deposits that are out there, and so we think that if they're almost like a call option on much higher prices, because if gold does go up, call it 2,000, a couple $100 more than here, or even higher, some of these big deposits that maybe didn't look good at 12 or 1300 are going to look very attractive because they have the size, they have the scale, right? And so we do have some of those. They've been they've started to work actually now. NovaGold's had a little bit of a run, but there's some debate on it. Is the capex too high? They're gonna have trouble processing, but I think the price solves everything there, and to have the size of that, I think 40 million ounces or something. It's a massive project. It's in a nice jurisdiction, so something's going to be done. We're actually waiting. It's funny because we're waiting to see what Bristow does with it. We're kind of split on whether or not it makes his IRR hurdle, but he's definitely making moves. It seems like he announces something once a week, so we'll probably see what gets done there. But yeah, I think those are probably later stage type of names because they're so far from construction even. They're not in production. So that is almost a right tail hedge for gold. And we're kind of would lean on the more bullish side. We think that, there's a lot of upside to come. We're not going to base our base case on that, but we think it's a real possibility that we get significantly higher prices. Especially if some of this, all this central bank shenanigans kind of blows up in their face. And, with something like NovaGold, we really like, Tom Kaplan, who's involved there. He's got a great track record. He owns a ton of the stock. And then we have a smaller position in Tower Hill, and we look at the shareholder list there, and it's Paulson owns a third of it, then Tocqueville, and then you got Tom Kaplan again. So, I think you've got whatever that is, 65% of the company is owned by four shareholders who've done pretty well here. So, but that said, I think the operational ones have done better. This is more of almost a right tail hedge, and I think you're starting to see them work, which tells me that there's probably going to be continued movement in the gold price, and then these things should really do well.
Any thoughts on silver at all, and also platinum, palladium, and then also anything on the base metal front, things like copper, perhaps?
Yeah, so silver, I think we're kind of under the impression that it should do better, right? It should have more of the leverage. The irony, the joke is that, the gold silver ratio everyone talks about, I forget what it's at now, 80 or 90 or something. And, everyone says, oh, that's a signal that, it's about to revert, and it just keeps, it keeps getting wider and wider. So, I don't know. I think eventually it happens. It's interesting that, a lot of the so-called pure play silver guys do have a lot of their revenue coming from gold. And so I think we're not really, we used to own some silver that did pretty well. We got out of it because the valuation got pretty high. But I think we're satisfied just owning kind of the gold guys that have silver as a byproduct. We're not necessarily we don't necessarily need to go just for the silver, because we think they're all going to move up. Look, eventually maybe that gold silver ratio does come back down, and then you do want some pure silver exposure. But I think we're fine with it as a byproduct at this moment. Platinum and palladium, obviously palladium's had a crazy run. We don't own anything that's directly tied to that. But we watch it, just like we watch any of these other things. I think for base metals, copper, copper's a tough one, right? We own Freeport, and we talk about how, it seems like for a while they weren't getting any love, and there's this disconnect between the long-term picture and then what happens in the short term. The long-term picture looks great, right? They're not finding the stuff. They're not, the demand picture is great, especially with all these, move to electric vehicles and all that. So the demand looks great. The supply is not going to be there to match it. And yet in the short term, people are worried about, oh, what happens with China, what happens with this and that, so there's like a very bearish short-term picture where the long-term picture is fantastic. And so, we've owned Freeport for a while. I mean, we've just kind of basically ridden it. It's interesting. There's discussion of whether or not Bristow comes in and buys them. I mean, I think he was, they asked him about it in one of his calls a month or two ago. We don't know. I think that copper is going to be a great long-term hold. What it does in the short term, I'm not sure. And that's kind of the downside of this, public equities, is that you have to report monthly. And so you may have these great long-term ideas, and yet the short-term picture is bad. And then you catch a lot of flack because people are like, oh, why isn't your stock doing well? I mean, uranium's a perfect example where, the long-term picture is great. Short-term has been abysmal. And so people think you're wrong. But then I point to some of the other names that we've had, that have done really well that we started out long. I mean, one of our best names this year is a company called Fulgent Genetics, a genetic testing company. We owned it for a few years. It was another one of these situations where the guy owned a ton of the company, had a great track record. He started a company, sold it for $1 billion. This is his next thing. We sat and rode it kind of $4 to $3. It was there for a few years, and now the stock's at 11 or 12. And so I think these types of things happen where you find these companies that have great long-term prospects. The short term might have a little bit of hair on it, or there's some issues there, and then the stock doesn't do well in the a few months or a few quarters that you own it, and the temptation is to think that, oh, you're wrong about it, but really it's just there are times when you can be early on something, and as long as nothing's changed in the fundamental picture, then it's either a buying opportunity or you should just continue to have the commitment to the name because nothing's changed. And so for something like copper, we basically, we don't really talk about it that much because we think, hey, the long-term picture is great. It's going to do what it does in the short term. But I guess from the metals perspective, most of our focus is on gold.
Yeah, and Freeport, we've had that for a long time, have done pretty well on it, and I think it's just a matter of time before it continues to move, and it'll be interesting to see what happens. I do like what's going on with copper, and we have some exposure, obviously, to all of these, but copper is looking quite fantastic in our view here.
Well, and it finally started to perk up. I mean, it's been down in the dumps for quite some time now. I saw that it hit like a kind of a multi-month high recently, if I'm looking at it correctly. So maybe it's the start of something.
Yes. And before we move on to uranium here, what's your view, Brian, on the use of physical gold ownership as a wealth protection strategy at this point?
Do you mean like physical, or like GLD, the stuff in the vault? I mean,
yeah, the real physical hold in your hand, wealth protection strategy with gold.
Oh, I think it's great. I mean, as long as you have a place to put it, you don't tell anybody about it, right? So I think the problem that people have with physical is storage, right? And so, I mean, unless you're sitting in the rocking chair with a shotgun, with the bars behind you, I think most people are going to be storing it at some sort of facility, and then there's always that concern about the facility itself, right? And so, I see a variety of different viewpoints on it. I can sympathize with why you'd want to own physical. I think from a public fund perspective, it's difficult for us to do it. I think maybe from a personal level, it's great as long as you figure out a good way to store it. That's probably the biggest issue. And then, I guess the real question is, I mean, this kind of goes more into the kind of conspiracy side, is, if you do own it and, stuff does hit the fan and all of a sudden gold's worth 5,000, the real question is, how do you sell it? How do you use it? I think there was an issue kind of in the last time gold ran up about counterfeits out there. And so I don't know, are you going to buy like one of those little, ultrasonic testers to see if it's real? How are you going to test to know? There's a lot of issues with the use of it. I think in theory it's great. But for us, we like the miners. We like the operating leverage, right? Because if you own the physical, and it's the same thing with the uranium physical funds, it's the same thing with like owning a GLD, is if the commodity price goes up, you're going to get one for one whatever that return is. Whereas if you have a gold company that has $1,000 cost, and the price goes from 1,200 to 1,300, well, the commodity went up 1/12, and the miner went up 1/2. So because you're looking at that change on the margin. So I think we like having the operating leverage of the miners, which is why we don't own GLD. in the uranium side, we don't own any of the physical funds. I think, I'd rather own, if I wanted safety, something like a Cameco or a Kazatomprom.
Now, certainly on the gold front, you got to have some of the operating leverage of the stocks, the producers, and so forth, and obviously the discovery upside in the cycle. And then certainly you need to have some kind of a blend of physical. That's a key component to have for wealth protection strategy.
Well, so where do you keep your physical?
Well, interesting that you ask. We've been a proponent in different content, but silver bullion out of Singapore is absolutely our favorite by a long shot.
So they store it in Singapore?
Yep, store it in Singapore. They provide you all the documentation, photos, etc. They have all of the verification tools if you choose to do verification. They have all that. It's stored by weight, not by value. They've really provided a number of solutions. They have inspection reports. They give you your specific parcel photos, etc. So it's really a fantastic way to step it out, put it in another jurisdiction that is arguably now at this point, given Hong Kong, probably the best jurisdiction in the world, probably at this point, potentially.
You sound like Jim Rogers. I think he sold everything and moved there. So maybe you're in a good company.
It's a fantastic place as far as that goes. So yeah, we do like that. Good costs, good solutions, good technology, good payment systems, and just easy to move in and out. They also have some other platforms as far as being able to lend, secured lending and so forth through their systems and their accounts there. So they provided a lot of good solutions, Brian. There is some counterparty risk with storage. As
that's what I wondered. Is it really yours? Is the question. I mean.
Yeah, from everything that we've investigated and seen, it really is yours. You can take physical delivery by order if you'd like. The parcel sizes are fairly small for people. If you have $10,000, you can do at least $10,000 per order. Typically, you can find a good product from the major mints that they'll store for you. If it's something smaller than that, they typically won't store small size in general, but 10,000 I think still pretty palatable for most people. And so it's a great setup, great service, great verification. I'm still an advocate of having your own physical in your possession.
I was going to say, I thought you were a shovel in the backyard kind of guy, but maybe you have a little diversification.
I think you need to have a blend. Certainly, you need to have both. There is always counterparty risk, but this particular group in Singapore, I think, is probably minimized counterparty risk pretty substantially. I think there's more counterparty risk in the U.S., but yeah, I think it's a good piece to have, but I absolutely agree. We're a big fan as far as having some of the major gold stocks and some of the operating leverage in the natural resource sector to precious metals. And that's pretty abundant in our portfolio. Well, let's talk uranium.
Sure.
What's your view at this point for uranium, and how has the strategy evolved for you since you got into this sector?
Yeah, so it's been a lot of waiting for it to happen. I think there's been some frustration with a lot of the general investors that, everyone sees this thing on the horizon coming, and yet the equities haven't yet performed. I mean, you're maybe starting to see a little bit of perking up. You've seen some of the spot pricing move up. In terms of how our outlook has changed, I think given all the delays that happened. I mean, if you remember when we talked, it was 232 was supposed to come out. I mean, at least the notification was in April of this year, and then the ruling was in July. And so, that the July thing they started the working group, it got kicked down to October, and then there was the month delay to November. And then, up until last week, there was nothing. There was a little leak that came out of Bloomberg. But I think our view has been that, time is not on your side if you're a really small junior, or if you have, significant cash burn and you don't have the balance sheet to support it, because you're going to have to raise, you're going to have to dilute. And so our view is that, the more of these delays were coming out, we thought we need to move kind of up spectrum, further from the explorers and more into the guys that were more conservative, the developers, and the guys that had the strong balance sheet. And so our portfolio has become a little more concentrated. It's probably some fewer number of names in the portfolio, but I'd say the top 10 are over 50%. We're not as top heavy as the some of the ETFs that are out there where it's 20% Cameco, 20% Kazatomprom type thing. We don't own any of the physical. I think just similar to what we were just talking about. I think if we believe that this thesis is going to work, we want the leverage of the miners, and if we didn't think the thesis was going to work, we wouldn't want to own spot anyways, right? And so I think
Right.
there's that middle ground there. And look, I'm not knocking anybody that owns it. I think it's great. If it works, you're going to do well. I think you at least get a double on it, right? Most people are talking 40, $50 is needed for this thing to balance. It probably overshoots that because of how long it stayed down here. So I think people will do just fine in physical, but it's not. We don't have it in our allocation. In fact, I mean, we own some of the bigger names in our bigger funds just because that's where the liquidity is. But the fund I manage, it's more of the kind of tier below that. Some of the developers, I think that has been one of the big shifts that we've seen. The other thing, that kind of shift that's taken place over the last 6 months was, we've moved a little more into the U.S. names, especially after the 232 when they all just got slammed. I think that turned out, in hindsight, obviously was a great time to be buying. We were doing so. I think our view was look, yes, he denied the 232, the quotas, but why would they do that, this whole working group charade, if they weren't going to do anything, right? I mean, why not just end it right there? And it's interesting to see, there's just something that came out today I mentioned with the rare earths, but, before 232 even got started, about a month before they filed that petition, Trump had an executive order looking at critical minerals, right, where they wanted to come up with a draft list, or a list of, whatever minerals were critical based on imports or, national security or whatnot. And so, that was really one of the things we were looking at before this whole 232 started. And so where everyone was looking at 232 and the Trade Expansion Act, we've always had an eye on this Defense Production Act, because that is kind of one of the mechanisms with which they can enact support for the industry. And so we've always been watching that, and you're seeing it take place in rare earths. In fact, about a week or two after the 232 decision in July, Trump came out with an executive order declaring rare earths. This was part of the Defense Production Act, Section 303, declaring them important for national defense. And I think that was what laid the groundwork for the news you saw today on the rare earths, where the U.S. Army says they're going to fund a rare earth processing plant. And you see a number of these stocks are flying. I mentioned on Twitter today, we talked about this Texas mineral resource company a few months back in a rare earths panel. They also have a big uranium resource. So, we own a small position. It's always nice when you come in and one of your stocks is up 50%. But, I think more importantly, it just shows that this is the kind of thing that the government can do when they want to support something. And so a lot of people are, despondent and sad, and they say, oh, hey, nothing's come out. All we've gotten is this leak. But it's like, hey, give it some time, right? I mean, that executive order for rare earths was in July, and here we are, whatever that is, 4 or 5 months later, and they're actually acting on it. And so I think the big lesson is, and probably not a lesson, it's something you should already know, is that the government takes a lot longer than most people expect to act on these things. And so that's been tough, is that, look, these are almost have an option-like characteristic, a lot of these junior equities, because they don't have revenue and they just have expenses. There is this steady decay. I mean, it's their cash burn, right? And so, there's it's almost like a option theta, where they're just going to decline and decline until one day, if the price is right, then they can actually go into business and start making some revenues. And so the longer the delay gets dragged on, the worse it is for these guys. And so we were, kind of more huddled around, got a more defensive posture, looking around, who has the ability to who can last, who can survive in this lower for longer environment. And I think, so that was a big change. And then also this shift to the U.S., where we thought, hey, this selling is overdone, kind of back in July, August. And we were buying these things because we thought, look, this nuclear fuel working group is actually a huge positive. We think something good is going to come out of it. It's very heartening to see what they did with the rare earths here today. I think you're going to see something similar where they support the industry. Look, our view was that Trump came out and he wanted to help the miners. I think he understood what Commerce was trying to say, but if they had done it with quotas, it would have essentially come at the expense of the utilities, right? Because the utilities would have been the one footing the bill. They would have had to pay higher prices. And look, the utilities have a big lobby. They've spent a lot of money. They have a lot of jobs too. They're in some swing states. I don't think he wanted to disadvantage a whole sector of the economy just to, help out a few miners in the West, right? So it seems like, at least our view, is that he wanted to help, but he didn't want to do it at someone's expense. And by doing it this way, where it essentially any help would come from the government, it doesn't disadvantage any particular party. And so that's why I think there is going to be a good outlet from this. And so, our largest position is actually energy fuels. I mean, I'm sure we might, get some snickers from some of the other uranium guys, but we think that the infrastructure we have that there is, we strongly believe there's going to be some help for the industry. And so maybe that'll turn out to be wrong. But, and like I say, most of our positions are very similarly weighted. So when I say it's our largest one, maybe it's a point or two above the rest. But we do have a number of, we have increased our U.S. exposure over the last 6 months because we think that, there will be some benefit to this, especially now that, look, the government, if it can come out of their pocket, right, they don't care. What's another few hundred million to these guys? They spend money like drunken sailors. So I think, it seems like there's going to be some support that happens here. We're looking at, so we do own a lot of the U.S. guys. I mentioned energy fuels. I think energy fuels it's not just about the resource. I think having that mill is a very critical piece of the U.S. infrastructure, and so I think they will be a beneficiary, probably the primary beneficiary, if any support is given, because any other company that is around them will probably be processing through their mill. Who knows? Maybe they'll give some loan guarantees or something to help start up some of the other mills, but we think that one probably does well. We look at some of the other guys there, Your Energy, Western. I mean, some of the guys around there, I think, are very interesting companies. And we look at enrichment too. I mean, there's so much focus on which one of these resource companies is going to do well. It seems like, kind of reading between the lines, watching some of these hearings, you see that there is a big focus on enrichment, and we don't really have domestic enrichment. I mean, we have Urenco, but it's owned by foreign companies in New Mexico. So the question is, and this is, I guess, also goes to just domestic resource in general, is what qualifies as domestic, right? Cameco was the largest producer in the U.S. Are they domestic? Is it because the production is here, but where's the ownership, right? And so I think that's an interesting question, especially like someone like Peninsula. They didn't participate in that rally, and you wonder, okay, is it considered domestic production, or is it because it's trades in Australia? So there's questions like that. And so for something like enrichment, where you have Urenco, who's basically the only one doing it in the U.S., and the rest of it's owned, or a lot of it's run by the Russians. You look at a company like Centrus and you wonder, is this thing ever going to come back into play? Because I mean, they've been down and out for so long. They went bankrupt. But look, if you read the history, I mean, they were the U.S. enrichment company. I mean, this was enrichment in the U.S. So we've looked at that company, wondering what's going to be the outcome. So I think maybe we focus on the U.S. a little bit more than some of the other guys out there, but we believe that they wouldn't have set up this working group if they weren't going to do something. And then just reading between the lines, looking at administration's people speak, watching the new Department of Energy head, his confirmation hearing, listening to some of the questions that were asked, it seems like there is a big push to reinvigorate the U.S. industry. And so we think, I mean, it's not, it's still a fraction of our portfolio, and we still like some of the other stuff around there, but that's probably one of the biggest shifts that's happened, this year for us.
Trump made a wise move because he can't be directly blamed for ruling against the utilities in the 232 outcome. But now, ultimately, we all know deep down that utilities are all going to pay higher prices going forward anyway. So it's a bit of a wash. But I wanted to ask you also, position size that you guys have there. And then can you give us, if you can share the information, can you give us a count of how many you have in the portfolio?
Yeah. So, so we have a few different funds, right? So the one I manage is kind of the uranium specific one, which has a lot more positions. So we have probably about 20 or so positions in that fund. Like I said, I mean, the top 10 are, 50 or 60%. So it's kind of there's a little bit of a tail there. We cut off a number of the names that were really further out. If you remember going into the end of last year, so we launched about the middle of last year, And we had a really nice tailwind going into the end of the year. I mean, spot was creeping up. It's got to like 29. So we thought, hey, maybe it makes sense to have small positions in some of these further out the risk spectrum names. I think as time dragged on, we saw spot come back down. We saw this stuff get delayed. We decided to concentrate more. So now we're probably only more around like, 20, 25 names, which is still a lot. I mean, I think, it's probably in line with some of the ETFs, but like I said, I mean, we're still much more concentrated around the top, 10, 15 names are almost all of it. For our other funds, we maybe have, 4 or 5 names. I think the weighting there is maybe 20-ish%, 25%. So we do have pretty big exposure across our more diversified funds, but those are a lot of the larger names, as you might expect. I mean, it's difficult to buy, an extremely small company, in a fund that's, 30 or 40 million, right? And so we have probably 5 or 6 different funds that make up the total assets that we have. So, yeah. And then in terms of top position sizing, I mean, in mine, I think it's probably 10% or so, 10 or 11%. In some of the other ones, it's maybe, 7, 8%, I think are our biggest ones. And so, it's nothing extraordinary, but we do have pretty concentrated bets on the ones that we feel the strongest about. And look, I think you see some of the moves that these names can have. I mean, look at last week what the U.S. names did. Your position sizes can grow pretty quick. And I guess that goes more towards kind of the overall thinking of just investing this way is, it's the tough thing you got to stomach is that a lot of these things, it's like this steady, slow bleed. And then when it works in a hurry, right? So you kind of lose money slow and make money fast. I mean, so not a lot of people like that. Most people would prefer to have just steady gains, but every once in a while you get wiped out. I mean, that's kind of what 2008 was, right? Is everyone's happy to earn their 5, 10% a year, 15% a year, and then watch out for the big wave. This is completely different. I mean, we're early on a lot of stuff. We'll sit there and it may go down a couple percent a month, but then when it works in a hurry. And so I think that's why we have these positions. So you have a 10% position, it goes up 10, 15% a couple of days. That's a pretty big move, and all of a sudden your position sizes start to rise. So we have to be a little more careful about monitoring how big some of these things get. Like I talked about the end phase, right? I mean, that thing, had we held it, it went up 30 times. I mean, it would have been probably a 50 or 60% position in the fund. I mean, it would have been the value of the whole fund that is now. So I think you got to be kind of careful about balancing what your view to the upside is with not having things get too far out of whack, because then your whole performance will swing, on 1 or 2 names. And so for us, I mean, look, it's still, these are all very small stocks for the large part. And so the portfolio swings pretty widely, in any given direction on a day. And so, I guess that's kind of desensitizes you to that normal volatility, which is why I say, I mean, the partners that are in this fund understand that it's a long-term view. A lot of the monthly performance is essentially noise, because when you see that, you can make back a month or 2 of performance in a day, I think they understand that, look, it's probably better to just, wait the time horizon out and then look at it, rather than, I mean, you can go crazy looking at the daily fluctuations with this thing. I mean, like I said, I came in today, that one stock's up 50, one's up 25, some are down 20. I mean, so you look around and it's pretty volatile. I mean, it gets muted out because you might have, it's maybe a 1% position or a 2% position, but these things can swing. And so yeah, I mean, we do have concentrated positions in the ones that we feel strongly about, but at the same time we're pretty mindful about our position sizes.
And how do you see uranium stocks going forward once contracting comes in and prices move? Do you see a substantial gap up, or do you see a slow, sustained trend higher?
Well, I mean, that's a good question. It's hard to say. I think it was interesting to look at the move last week when they had that leak, and you had a number of the U.S. names were up 10 or 15%. And then then they kind of pulled back a little bit. So I think maybe it'll be a combination of that, where when we do get big news or big catalysts, you'll see some big moves, especially in some of the smaller names, right? I mean, you look at a company like Western Uranium. I mean, that thing went from, I don't know, 70 cents to $1 in like a few days, right? So that's a pretty big move. I think there will be those types of punctuated gaps, but I don't think that'll be the whole move. I think it's kind of 2 steps forward, 1 step back. and then, but I think the gradual overall trend will be higher. I mean, there's a few names that have done well, like the other day. Global Atomic is one of them. You've talked about them in the past. It's done quite well. It's been a pretty steady march higher, and one of the reasons is because they do have that other asset that produces cash flows, and there's some debate now whether or not they're going to need to raise to essentially bridge a gap to their next dividend. But I think that is the overall trend is up, and I think for some of these other names, if you go out a year or so or two, especially if the prices continue the movement that they're on and there's no change to the fundamental picture, you should see upward movement in these things. And hopefully we're getting that thing started. I think a lot of people have been in this trade for a long time, wondering when it's going to get started. It's interesting. It seems like there's this almost unanimous agreement that this supply deficit exists, that it's going to have to be remedied. We're going to need higher prices, and yet because it's in the future, the stocks just continue to trade down until we get there. It's almost like you need the thing to just beat you over the head. I mean, in fact, Cameco talked about that in their last conference call. Was, hey, look at what's happened in conversion. Look at what happened in enrichment. The prices have gone up, and yet they've gone up so much, and yet you go back and look, the actions that set those movements in place happened years earlier. So why does the market waiting for like the crunch time to hit them before they start pricing this in? And so one of the biggest questions we get is about timing. When is this thing going to happen? And our view was, well, look, it's not necessarily when the timing of the supply crunch is. It's when is the timing of when it gets priced into the market. Because if everyone sort of agrees that it's going to happen, well, you should expect that the equities will start to price that in ahead of time. It's not just going to be this flat and then maybe a hockey stick straight up. Maybe it is. I mean, that's kind of what the past has shown us. But I think that's very unusual for markets to operate that way, where people kind of generally see something coming and then they wait until the day it gets here to mark all these things up. So we would think it would be more kind of a gradual rise. It's nice to see spot starting to pick up. It would be great to see some contracts. The price reporters aren't doing any favors by kind of lowballing the prices they report, even though you got guys talking about contracts that are already being done at much higher prices. So look, we think it all shakes out the right way. I mean, the long-term view hasn't changed. If anything, it's gotten stronger. I mean, it seems like every day there's something positive on the demand side or some other supply that's coming off. And so, the coil keeps getting tightened. Our view is the longer this thing goes on, the more dramatic the price move to the upside is going to be. And these things are essentially trading like options, right? I mean, for a lot of these projects, you look at the value of them at kind of a normal price level, 40 or 50 bucks, they're hundreds of millions of dollars, and yet the stocks are trading maybe sub 100 million. So something's got to give there. Unless you think that the price is not going to get there, well, then these things are going to be zeros. But if we think that the supply deficit is going to force that price up to at least that incentive price, well, all these things have massive upside. And so for us, we can wait. I mean, look, yeah, it's a little painful, for your investors saying, hey, we're a little bit early on this thing and these things are kind of languishing for a while. But, do you believe in the thesis we're laying out there? If you do, you're going to do extremely well. Just hang tight. And I think that's what we're doing here. And, it's very hard to wait and people are frustrated and they're bored or whatever it is. But, if nothing's changed in the thesis, then you should be just as excited as ever.
Certainly some sound points you bring up. How about specific companies? Is there anything you want to mention? Is there a specific company other than the obvious disconnect out there? Is there any company that has a really odd disconnect or an odd situation that you see in the sector? And what do you see happening potentially in 2020?
I don't know. I mean, I think there's an odd disconnect with all of them, to be honest. I mean,
Right.
these things I think should all be essentially baking in the fact that this market is not going away. Nuclear is not going away. And so it's going to have to balance. And these things are going to be operating in a normal environment, whether it's, 1, 2, 3 years down the road. But they're all going to be valued based on that normal environment. And that's much higher. And so, I think there's a disconnect with all of them. I mean, there's some funky names that we have some small positions in. And we talked about Virginia last time. I mean, that's a really interesting one, right? Since we talked, they lost the Supreme Court case and the thing got slammed, and then it got compounded because Sprott wanted to get out and they were like a 10 or 15% shareholder. And so the thing's, I don't know, it's like trading for $1 million or $2 million market cap. And, it's still got 100 million pounds in the ground. And there's a reasonably well-defined way for them to get it out. I mean, I think, I'm probably a lone voice here and people probably think I'm an idiot for talking about it, but I just think it's a really intriguing one. It's not like it's a big position for us, but it's something that's really, like you say, there's a strange disconnect there. a lot of people think it's dead. It's never going to come out. And yet, if you like read through the Supreme Court opinion or the transcript, the judges themselves are like, look, there's a very well-defined way for them to get this out. If the government wants it, they can just take it. They can just condemn the land. And I actually talk to Walter Coles, every now and then, every few months, just to kind of get an update on what's going on. And he's like, yeah, I mean, they're essentially working on that. They have another court case that they're doing in February where, they had originally suspended it because, I think there's a better odds of getting heard at the Supreme Court if you don't have other cases pending. So they suspended it. They reopened it. It's in this county in Virginia that's pretty favorable to mining. So, that's an outlet. But I still think the best option for them is eminent domain because, look, I mean, if the resource is good. In fact, I talked with, Energy Fuels is a big shareholder in them. And so anyone who owns Energy Fuels basically has indirect exposure. And I talked to Mark Chalmers about it. And the position was bought, predated him. It was the last guy who took the stake when he was kind of building up all their assets. And he's like, right. Look, I was in the industry back when they were doing this project. It's a great project, right? I mean, it's near surface. It's large at scale. It's a small footprint. So, I mean, if the government wanted to essentially boost their supply, this would be an interesting way to do it. I think one of the things they're discussing is potentially like a sale leaseback where the government would seize the land, and not even the whole land. I mean, they would just take basically the small part of land over the top of it, and then kind of lease it back like any other federal land, for oil or gas, lease it back to the company to develop it. That's an interesting one in our opinion. I mean, maybe it goes nowhere, but I mean, the fact that you can buy, high grade, not necessarily, but relatively high grade for the U.S. uranium at, basically a penny a pound. That if they wanted it, they had a pretty simple way to go about it. I think that's an interesting one. But there's not a lot of, like I said, I think all these things are disconnected, right? I mean, I think Centrus is interesting. I don't know what's going to. They have some hair on it, right? They have some pension liabilities, but we'll see what happens with enrichment. I think there's a lot of focus on mining, but enrichment's a really key bottleneck there. Do they get set up with some of the plants? Look, it's all going to depend on what comes out of this. All we got so far was this little leak that talks about stuff, and you saw some of these names start to run up on it. But I don't know. I think the vanadium guys are interesting. I think Western looks interesting. What's funny is we talk to a lot of people in the industry. The miners, the utilities, the intermediaries, traders, lobbyists. I mean, we talk to everybody. What's funny is some of the traders who you think are would be the most bearish because they're kind of trying to sell you stuff. Even they agree that this bull market in uranium should happen. But we met with one about a month ago, and they're like, we actually like vanadium better. I mean, and so they look at this Western mine, and I remember about a year ago there was like some chatter about how they didn't have their offtake agreement. They would have to go through White Mesa, and there's like some bitter relations there because essentially they bought it. They bought the Sunday mine at a fire sale from Energy Fuels. Energy Fuels won't want to let them come back and all this kind of jockeying back and forth. But I think having that optionality is interesting. A lot of these companies, they just trade for such distressed valuations that look, maybe if this thing goes on and we're talking a year from now and it hasn't moved, then these things are duds. But I think there's just a lot of stuff out there where the valuations are just so low. People are going to look back, if this works, if we're right about the thesis, people are going to look back and be like, that was just crazy. They were giving these things away. And anyone who just had the stomach and the capital to kind of sit there and, hold their nose and buy these things is going to do extremely well. So I don't know, kind of a long-winded way to say, yeah, everything looks good, but there's a few things that are kind of really wacky.
Any thoughts on other jurisdictions? So thoughts on Africa, and then also can you share any thoughts you might have with other jurisdictions that maybe not proven up, like maybe South America? And then also, Brian, if you wouldn't mind, did you see, I know you've recently gone to some of the industry conferences. Was there anything unique that came out of those conferences that you want to point out?
Sure. So I'll start with the jurisdiction. So we like Africa. I mean, we own Global, we own Bannerman. We own GoviX. I mean, those are pretty big positions. Some of them they're high cost. Like Bannerman is extremely high cost, right? I think Australia, we own some Vimy. We think that there's gonna be these projects are gonna be needed. I mean, we probably our largest non-US is Global right now, just because we do like the zinc asset they have. But I think in Canada, NextGen and Denison are the two big projects. Fission as well, though. Fission's just been getting destroyed. I mean, what a rough go that company's having. I mean, it's crazy when you see the CEO come on like Twitter and he's like, "Hey guys, I don't know what's going on. I'm buying stock. I think someone was selling it or something. But anyways, look, those are kind of the big three projects that have yet to be developed. We don't own a lot of exploration. I guess we probably own. That was one of the things that really we kind of shifted away from when when it turned out there was going to be these delays. We still like the exploration companies. We do have some exposure. We like the ones that have found something. So, like, I think probably the two we own are ISO and PurePoint are the two that we, have some exposure to because, look, they've found something. They're in the right neighborhoods. I mean, with PurePoint, you're right across the border from NextGen's Arrow. They've already had some pretty good discoveries. They have great partners in there with Cameco and Urano. That's an interesting one to us. I think with ISO Energy, obviously they're right near all the infrastructure on the east side. They have the huge, anchor shareholder in NextGen who just, participated in the latest financing. So, we don't own a lot of exploration because I think at this point, especially if there's continued delays, it's going to take a while those things are way down the road, but they're very exciting places to be if this market ever does pick up.
And how about conferences? Anything that came out of the conferences you recently attended?
Yeah, so I was at WNA in London in September, which was great. I mean, that was my first time going there. I think what I really liked about it was, the concentration of people in such a small place. I mean, it was almost every mining CEO was there. My calendar, and they're all in this little bar kind of in the lobby, right? And so you're sitting there and it's like every miner you can think of and they're all sitting talking to someone else around you. So got a lot of great meetings there. You can talk to a lot of the utilities. It had more of a global focus, I think, for the guys that were interested in the U.S. going to the Nashville conference. The NEI was probably had more of a U.S. focus, but it was great. You got to catch up with a lot of guys that we're shareholders with, talk to a lot of the funds. I talked to, Sachem Cove, Segra was there, L2 was there, and so we're all kind of doing the same thing, kicking the tires, talking to these guys, doing these meetings. It was nice to be able to kind of catch up with all these people. And yeah, I think the big takeaway from that conference was that, you look at all of the demand cases, base case, low case, high case, and they all had increasing demand. And so really, you had for the first time in 8 years a positive outlook for this industry gathering, which was new. And I think that you're starting to see this growing recognition. A lot of guys like us who've been watching this thing are like, yeah, this thing has to happen, but it's not going to happen until the utility fuel buyers and all these guys come on board. And I think that's what you're starting to see. Same thing with the Nashville conference. We weren't at that, but I talked to some people that were there and, heard some of the takeaways. And obviously, Sachem Cove gave their presentation and seemed to get a pretty good reaction to it. So I think that, there is this growing awareness that something needs to change. Prices need to rise. I think the utilities are becoming more receptive to it. If the spot price continues to rise, that should give them some justification for signing higher price contracts, which would be great for the market to see. And, like I said, we still have very strong conviction in this thesis. It's just a matter of time. We're just waiting for it. And I think, look, yeah, there's only a few weeks left in 2019, so maybe we can turn the page there. But, look, every day that goes by is a day closer. And I know that's kind of a cliche, and people, that are watching that are kind of bears on the uranium thing. I mean, these guys have been a broken record for years and years now, but I think there's enough signs showing that we're getting much closer to the turn. I think looking at the other prices in other parts of the fuel chain is a very strong signal. I think it's just a very, we're very close to seeing those strong price movements pull through to the U3O8 side. And then it's just the equities following. And I think they're so depressed right now. I mean, the spring is so tightly coiled that it doesn't take a lot. And I think that's what you saw last week with that leak from the working group, was that these things are waiting for news. And I mean, any sort of news that just gets them, the moves are pretty dramatic. And so, we're very happy with the portfolio we have. And like I say, I mean, the one I have is almost entirely uranium. And so, we're very focused there. But even in our other portfolios where, we have a pretty significant weighting. Thankfully we have some of these other areas that are doing very well for us that can kind of offset, what's happening in uranium while we wait. But then, I would expect the baton to be passed, and next year or so we'll see, these names leading the way.
Yeah, we don't have any problem waiting here either. Perfectly patient to sit back and relax and selectively chip away. That's certainly been our view for quite some time now, and we have no issue continuing. Now, Brian, can you speak to for folks interested in Old West, is the group still open to new investors? What are the primary terms, and how can they reach out to you?
Yeah, so we are still open. All of our funds are still open. We're available for accredited investors, and so if you are accredited, you can reach out to us, and we can go over all that type of stuff. And it's traditional. It's a partnership structure. Traditional terms. I think you know, we have probably in this new fund, we have, a dozen or so partners. And, in our other fund, so basically this fund is for people that are looking for the concentrated uranium exposure. And then our other funds are more, if you like the uranium idea, but you want some of the general stuff. I mean, look, like I said, you're making a big bet on uranium. It's going to work good or work poorly. It's that concentrated. But, you look in some of our other funds, I mean, like I said, I mentioned that N phase is up 400%, Fulgent's up 300%. Like some of these other ideas, you're not going to find in a fund like this. And so if you like the more diversified exposure, those are much more focused on, kind of the owner manager special situation, that type of investment. And that's actually how the fund I manage got started was, we had that's our general process that kind of overarches everything. When the uranium weighting started getting up and up and up, we thought, hey, it doesn't really make sense to have a diversified fund with such a large weighting in uranium. So we essentially kind of capped it around that 20-ish% level and said, for anyone that's interested more fully fleshing out this uranium theme, we'll set up this new fund. And it's been pretty people have shown a lot of interest in it, especially either current clients or guys that were interested in the theme. So, yeah, just reach out to us. I mean, you can find us on our website. You can reach out to us on Twitter. We're pretty good. We talk to a lot of people in direct messages. So there's a lot of ways to get a hold of us. Give us a call. I mean, we always are happy to talk about it. So, we would look forward to talking to anybody.
Okay, well, Brian, let's leave it there. It was really good to catch up. Thanks for coming on the show, and we'll speak again soon.
Thanks, Andrew.